So what if you could flip the script on your bank? Instead of just being a depositor, what if you could actually be the lender? Well, today we're diving headfirst into the world of private credit. We're going to explore how you can potentially capture the kind of high-yield returns that, honestly, banks have kept for themselves for a very long time. We're going to break down what it really means to step out of the customer line and, well, become the bank. It really does all start with this question, right? For years, most of us have done the same thing. We put our money in a bank, we earn this tiny little sliver of interest, and then the bank turns right around and lends our money out for a much, much higher return. But what if you could just bypass that middleman and capture that profitable spread for yourself? And this slide really nails the two different roles. Look, as a depositor, you are essentially lending your money to the bank. You get safety, sure, but a minimal return. But when you become the lender, you're the one providing the capital directly to a business. And in exchange for that, you're in a position to demand a much higher rate of return. It's a total fundamental shift in perspective. Okay, so this shift in thinking leads us straight into our first section, the lender's opportunity. You see, a pretty fascinating gap has opened up in the financial market, and it's creating a chance for investors like you and me to step into a role that was, for a long time, only for the big banks. So here's the deal. After the 2008 financial crisis, a bunch of new regulations came in that made it way less profitable for big banks to lend to mid-sized companies. Now, these are solid businesses, the backbone of the economy, and they need capital to grow. But they're kind of being left out in the cold. This has created a vacuum, and a whole new class of lenders has jumped in to fill it. People call them shadow banks. And for us regular investors, the most common way to get a piece of the action is through something called a business development company, or a BDC. So before we jump on this opportunity, we really need to understand what it is we're actually buying. And that brings us to our next section, the anatomy of a loan. Let's break down what it really means to own a piece of a company's debt. At its heart, it's actually really simple. When you buy a company's debt, you are just giving them a loan. In exchange for your cash, they give you a sort of IOU with a promise. And that promise is this. They'll pay you regular interest payments, that's your income stream, and then, at the end of the loan's term, they'll pay you back your original investment in full. You've just become their creditor. But here's maybe the most important question you have to ask when you're the one lending the money. What happens if things go wrong? If the company goes belly up and has to sell everything off, who gets first dibs on whatever cash is left? This right here, this is the bankruptcy pecking order, and you need to know it. First in line, always, are the debt holders. That's you, the lender. The company has a legal obligation to pay you back before anyone else sees a single penny. After you're paid, then preferred stockholders might get a shot. And who's dead last? The common stockholders. And let's be honest, by the time it gets to them, there's usually nothing left. And that right there, that pecking order, that's the whole game. Having that first legal claim on a company's assets is precisely why lending money is considered, at least in theory, less risky than owning that same company's stock. You have priority. It's that simple. But here's the thing. Less risky does not mean no risk, not even close. And the amount of risk you take on is directly tied to the return you can expect to get. This brings us right to our third section, the real price of yield. All right, let's look at a real-world example to make this stick. On one side, you've got a bond from Sanofi, a massive, super stable pharmaceutical company. It's yielding about 1.23%. On the other side, you have a bond from the struggling retailer Bed Bath & Beyond, which at the time was yielding a massive 7.68%. I mean, the difference is just staggering. So the obvious question pops up, right? Why wouldn't everybody just pile into the Bed Bath & Beyond bond and make a killing? Are you really getting an extra 6.5% for free? Is this some kind of free lunch the market missed? And the answer, as you probably guessed, is of course not. That higher yield isn't a gift. It is a giant flashing warning sign. The market is telling you it's pricing in a much, much higher chance that Bed Bath & Beyond might not be able to pay you back. That high yield is your direct compensation for taking on that very real risk. This whole concept has a name. It's called the risk premium. It's the extra juice, the extra return you demand for shouldering the additional risk of a potential default. And what's really interesting with private credit is this often comes in the form of a floating rate. This means the interest rate on the loan isn't fixed. It actually moves up and down with benchmark rates. So when the Fed raises interest rates, the interest payments you receive also go up. That's a huge potential advantage in today's world. But this all brings us to the brutal truth of being a lender. Risk isn't just some number on a screen. It becomes painfully real when the economy takes a nosedive. So, let's talk about what happens when the cycle turns. Think of the economy like it's breathing. There are periods of expansion, the inhale, when money is cheap and credit is super easy to get. But then there are periods of contraction, the exhale, when lending standards tighten up. For a really healthy company, this is okay, it's manageable. But for a weaker company, one that relies on borrowing new money just to pay off its old debts, a turn in the credit cycle can be an absolute death sentence. And we are not talking about a small risk here. Just look at this number. According to historical data, during major economic downturns, nearly 30%, that's almost 1 out of every 3 of these speculative, high-yield companies have defaulted. Just let that sink in. The risk of getting zero back is very, very real. And a company's failure doesn't just happen overnight. It follows a pretty predictable and ugly path. It starts with insolvency. That's when their debts are bigger than their assets. This almost always leads to delinquency, where they start missing interest payments to lenders, like you. And that ultimately ends in bankruptcy, a formal legal default. Now, here's the crucial point I really want you to get. The very same companies that are offering those juicy, high-yield loans in the private credit market are often the exact same ones that are most vulnerable to this path to failure, especially when the economy hits a rough patch. Okay, let's pull all of this together in our final section. We've seen the opportunity, we've looked under the hood at the mechanics, and we've stared the risk right in the face. So the final question you have to ask yourself is this: are you being paid enough to wait and see what happens?
So here are the key takeaways from all of this. First, remember, high yield is not a free lunch. It's just direct compensation for taking on high risk. Second, yeah, you get paid first in a bankruptcy, but that's only if there's any money left to pay you with. Third, these credit cycles can turn on a dime. And finally, and most importantly, default is not some abstract idea. It is a very real and common possibility.
I want to leave you with this really powerful line from the source material. Investing in risky debt is basically a bet on an insecure future. If that company you lent to survives and thrives, you absolutely must be rewarded handsomely for being right. Why? Because if you're wrong, the penalty is usually a complete and total loss of your investment. And so we end right back where we started, but with a much, much sharper question. See, it's not just about becoming the bank. It's about learning to think like one. When you step into the role of the lender, you have to ask yourself with eyes wide open, is the potential reward here truly big enough to justify the very real risk of never, ever getting your money back?